Well, hello and welcome to this week's update. So let's jump straight into it. What did we see this week? Well, we saw that the QQQ failed at the 21 EMA. We saw last week it had just broken above the 21 EMA. We were expecting a move up to the 50 and then start to move down. What happened? Well, straight away it failed at that level and started to move lower immediately. So what did that mean for our QQQ call spread? Well, it means that we had a losing trade. Very small losing trade, but a losing trade, right? We lost $50 a contract. So that trade was automatically stopped out with the use of our bracket orders that we teach you guys, our set and forget trading. Make sure you contact your coach and you walk through that process. It's really important you understand how those set and forget trades work. Very effective, and this just stopped us out for a small loss. So how have we been going? Well, the last sort of 40, 50 odd trades, you can see that we've had 36 winners. Now, with that losing trade from last week, 6 losers and 1 break even. Pretty good record, right? You can see we had a good winning trade on Netflix, and winning trade there with put options on NLOK. There's another winning trade on the QQQ with a put debit spread, 66% return in a week. Had another winning trade just by buying put options on the QQQ, made a 62% return in a week. Just going to keep going till we have a losing trade, right? SQQQ, we had a winning trade there of 58% return with a call spread. We actually bought call options on the SQQQ, which moves up when the NASDAQ moves down, right? It's an inverse related ETF. We had a 55% return winner there. And XLE is where we had a small losing trade of $12 a contract. So as you can see, with 36 winners and only 6 losers, we've been doing very, very nicely. So that's what happened last week. Now, as far as the SPX goes, which is our best gauge of the overall stock market, very much the same thing, right? We thought that it could come up to the 50-day moving average, which would mean it would fill that gap, right? You can see this gap here in the price. We were looking for that to move up to the 50-day moving average and fill the gap, just like we saw with the QQQ. Well, we didn't get that. Straight away, we failed at that level and moved below the 21 EMA. Now, the first trading day of the month, which was Friday just gone, the 1st of July, we need to reset the opening range. So these are the numbers you need to write down. 3829. So if it's above that level, closes above that level, we're in bullish opening range mode in the stock market. If we're below 3752, we're in bearish opening range mode. Okay, so write those numbers down so you know whether we're bullish or we're bearish, likely to move up or likely to move down. Okay, so that's very, very important. Now, if we have 10 points that we look at to understand market internals, okay, to understand really with high probability what's likely to happen with the markets next. Now, any one of these points that I'm just about to talk to you about is no good by itself. It has to be used together. So in other words, all 10 of these points need to be looked at as one signal. Okay, you need 7 or more of them telling you that the market's about to move down, or 7 or more telling you the market's about to move up. When you do have 7 or more telling you the market's about to move down, that's when you start setting up put options like we have done recently on the indexes, okay? Or using inverse ETFs, which we did very effectively as well. So let's have a look at what's going on right now with those points. Let's look at some of them. Well, we'll look at here at the combined index equity put call ratio. Now, we look at the 10-day moving average here. Okay, we look at the 10-day moving average, and right now you can see it's at 0.99. So what does that tell us, Sean? Well, something 1.0 or around 1.0, very close to it, in this case 0.99, shows that there's too much fear in the market. Everyone's hedged or short. There's no one left to sell. So this is actually a bullish sign. But again, by itself, you can't simply look at that and make a decision. But that particular point is bullish. If we look at the amount of stocks that are above their 50-day moving average, if it's below 50%, right now it's 31, if it's below 50%, that's bearish as well. So one bullish, one bearish. And we have a look here at the SPX put-call ratio. Now, something 1.75, right now we're at 1.43, something 1.75 or below shows there's excessive call buying, call option buying, okay? And this is actually bearish. So there's another bearish sign there. Then we have the trend, the most accurate overbought, oversold reading on the stock market, right? Or on the planet, should I say. Now, something that's above 2, right now it's at 0.88. Something above 2, you're looking for the markets to move higher over the next 2 or 3 days with 90% accuracy. We don't have that right now. Or something below 0.5, you're looking for the markets to move down over the next 2 or 3 days with 90% or more probability of that happening. But again, right now, it's neutral, okay? So there's some neutral signs there. Our opening range, which is only set on Friday, obviously that's neutral because it's only just been set on Friday. But if we go and have a look at our stacked moving averages here, when they're stacked like this, the 89 on top, these are all exponential moving averages, okay, all based on Fibonacci numbers. So when you're getting the 89 on top, which is the red line, the 55 EMA, 34, 21, and 8, when they're stacked in that sequence, from highest to lowest, that shows that that particular security or index or whatever you're looking at is in a downtrend, right? So obviously right now the SPX is in a downtrend. But if we have a look at high yield bonds, which is one of those 10 points, that's certainly in a downtrend. This is the risk appetite of the market. And then we look here at junk bonds, we can see that they're also in a downtrend. Another one of the 10 points is transports, and that's stacked bearishly as well. So we are getting quite a few of these 10 points that we look at to gauge what the market's likely to do next that are telling us that the market is bearish. It's not quite there with a 7 yet, but it's very, very close. It could change in a heartbeat. I'm going to give you one of the reasons that I think could trigger this market to really start to sell off, and part of it is due to earnings. Now, earnings for one of the largest stocks in the market is Apple on the 28th of July, right? So Apple's having earnings on the 28th of July after the market closes. Market opens 9:30 a.m. New York Eastern Time and closes at 4 p.m. New York Eastern Time. So this is 4:30 p.m. after the market closes. It's got a tick, so you can really rely on that date. It's been confirmed with the company. So Apple's going to be reporting their earnings in just over 3 weeks. Now, if you have a look at this, you can see that the weighting of Apple within the largest sector in the market, technology, biggest sector that there is, both Apple and Microsoft make up a huge portion, almost 45% of the entire technology sector, and Apple making up a very large portion. And also, Apple actually makes up the largest portion of the SPX, has the biggest weighting. So when you're getting the overall market, the SPX, and the biggest weighting stock within that index, Apple, about to have earnings, that's something you need to be mindful of, particularly when you get headlines like this. The fact that China's shut down, well, locked down, should I say, 17.5 million residents with its zero COVID policy. It's closed Apple factories and risking chaos in global supply chains. We can see here that Apple production has been halted at 3 key Chinese suppliers, hitting the iPhone, which makes a very large portion of Apple's revenue, iPad, and Mac. So when you're getting the earnings for Apple that is coming out very soon on the 28th of July after the market closes, then you understand that the earnings are probably going to be pretty bad. I don't think the earnings are going to be good here at all. And when you're getting such a big company within the markets likely to move down, that's going to trigger the markets and the indexes to move down as well. So this could be a big trigger here. Now, another stock that has a big weighting within the SPX is Tesla. Now, they've got earnings coming out on the 20th of July. Now, Tesla has had some problems. Again, has a very large factory in Shanghai in China. That's been shut down for just about all of April and has only just resumed full output in early June. So this shutdown that's occurred with Tesla's largest factory in Shanghai, that's really impacted the amount of vehicles that Tesla can actually produce. They've produced just over 250,000 in the second quarter, and that's down 18% from quarter one, which was 310,000. So that's a big drop. So you may get some pretty average earnings for Tesla, which has a large weighting in the SPX, and some pretty average earnings for Apple, which has a very large weighting in the SPX and the overall market as well. So, when the Fed talks about a soft landing, I think we can pretty much say that ship has sailed. Okay, right now the Federal Reserve is trying to destroy demand. Right, they're trying to reduce demand, the amount that people are going out and buying, because that's going to help curb inflation. Okay, that's what they're thinking. Right, we're going to crush demand. We do that by raising rates. Interest rates in America for houses was only around 3% not that long ago. Right now, just a couple of months later, it's almost at 6%. So they're really trying to cool down the housing market. They're trying to cool down demand, and all of this leads to the markets going down. Right? Several rate rises still to come, inflation at 40-year highs, and really, if we understand that inflation is really 17% in the US if you measure CPI the same way that they did in 1980s. So that's probably a more accurate figure. There's many reasons why they don't do that. I won't go into it all now, but the soft landing is over. Right? We are headed for a recession. I think that's almost a certainty at this point. Okay, so we've got quantitative tightening going on with the Federal Reserve for the first time in a long time, since 2008, and raising rates, and the misery index, which is high unemployment, high rates, and high inflation, this doesn't lead to a good place. So we're watching the markets very closely here, because we could start to see some selling very soon, and we want to be mindful of that. And when the earnings comes out for large companies like Apple in particular, end of July, and Tesla, we need to be watching those things, because they could trigger these markets to the downside. So having said all that, let's go and have a look at potential opportunities for this week. One of them is on GOGO. So let's have a look at the stock first on the chart, and let's have a look. So GOGO. Okay, so clearly we have moved below the 89, which signifies a change in direction. So this is when you're getting a change in trend, when it does close below that 89. It's not stacked beautifully in a downtrend yet, but this is a change in direction. When it was above the 89, now it closed below. That's a change from uptrend to downtrend. Now, the other thing that I see when I look at this is a beautiful bear flag. Okay, so we've got a bear flag here. As you can see, the pole here and then the flag, which is just broken right now, which is the 200-day moving average, which is significant in and of itself. So we've broken the 200-day moving average. We've got a bear flag that's formed, and we've got a gap to fill. In other words, the price come down to this line to fill the gap in the price, which is a high probability as well. That's a high probability trade. When you have that many things in your favor, you execute the trade. There's not much else to think about. So for me, I think we could at least come down to 1375 to fill this gap, okay, based on the overall market moving lower, based on the fact that it's broken the 200, based on the bear flag, based on filling the gap, okay? So having said all that, let's have a look at the opportunity. Now, again, I want to be very conservative right now with spreads, not going straight out with options at this point, because we still don't have an opening range yet, because we only just set it on Friday, right? So what I'm going to do with this GOGO, with the stock here at 1567, I'm going to set up a trade out to the 19th of August, 47 days from now. I'm looking for the stock to move below 14. Okay, looking for it to move below 14. Okay, so we're going to buy the 16 put option and sell the 14. Maximum, well, the cost is $87 a contract. Okay, the difference between the one we're buying out of pocket, the one we're selling, money coming back into our pocket, the difference between the two is 87 cents, right? Now, I wouldn't pay any more than 95 cents. Okay, so if you have to increase the limit price to get the order accepted or filled, that's fine, right? There's no problems with doing that, but don't do it beyond 95 cents. If you don't get filled at 95 cents, leave the trade there and see if it does. If it doesn't, that's okay. Wait for next week and there'll be another trade, right? Now, the maximum profit here is $113 a contract. Okay, the difference between the bought and the sold strike prices, 16 and 14, is $2. That's the maximum value of the spread at any time. Minus the cost of 87 or 0.87 gives you the amount of money that you could make, $113 for a risk of 87. Okay. Now, obviously, if you did 10 contracts, that's $870 you're spending to make $1,130. Okay. Now, to work out the break even, in other words, where I start to make money, the buy strike 16 minus the cost 87 gives you 1513. So if it moves from 1567 to below 1513 at expiry, you're in profit. So again, if you don't understand the spreads yet, you've only just joined us, say last week, for example, that's okay. You're not meant to know it yet, right? Two things you're going to do. Number one, you're going to contact your coach. Say, I need to book a session. I like Sean's trade on GOGO. I'd like to place that, but I need you to walk me through how it works and help me place it and understand it. Okay, great. Book your session with your coach, right? If you've done 1 or 2 sessions with your coach, that's not enough. You need to do all of them to really understand what we're doing here and make a lot of money. The other thing you can do is send an email to support@cashflowoptions.com.au. And then the third thing that you can actually do is wait for the workshop. We've got a 3-day workshop coming up, only 4 hours a day, 3 days, and it is always incredibly well received. We get huge feedback from it. People love it. We'll take your trading to another level. We'll explain everything in detail. You will absolutely get a huge amount out of being there. It's a must. You must go and see that. So if you've never been to one before, make sure you attend this workshop that's coming up very, very soon. The invitation and the dates to people that have never been, just to people that have never been before, will be coming out very, very soon. Make sure you do that. So there's 3 ways that we can really help you start to place trades like this and really start to see the huge asymmetrical opportunities, right? And set these as set and forget. Right? Set and forget trades. That's a beautiful thing about this, right? We set the trades up and we let the trade manage itself. So if we set our stop here at $37 a contract, $87 goes out to buy the trade, okay, to buy the investment. And if the trade goes the opposite way to what we want, it goes against us, then we would have our stop triggered and $37 would come back into our account. So $87 we're spending to buy for one spread, and then if the trade goes against us, $37 will come back into your account, obviously leaving you with a shortfall of $50 a contract. Your potential upside is 113, so it's more than a 2-to-1 risk to reward. So certainly an asymmetrical opportunity. Now, Apple is another one that I'd like to enter bearishly for the reasons that I've already explained. Now, if you have a look here right now, we are trading at just under 139. We're going to go for the 19th to the 8th expiry. I know earnings is coming up soon, but when you do a spread, you're sort of canceling out the volatility, right? You're not paying too much because you're buying one and selling one at the same time, right? So you can still do spreads with earnings that are coming up. Now, I'm going to buy the 135, sell the 130 for $157 a contract. I won't go through the whole thing this time. I'll go through it a bit faster. $343 a contract for $157 outlay. Okay. So if we set our stop at 57, we spend 157, set the stop at 57, we're only risking $100. And our potential upside, if the stock Apple goes below 130, is 343. So we've got a 3.3 a 3.43 times higher potential profit than the risk. 343 if we're successful, it moves below 130, and we're only risking $100 if we're wrong. So certainly a very large asymmetrical opportunity that is in your favor, right? So that's another opportunity right there to make money with Apple. And then lastly, I've got a earnings trade here, an earnings trade idea for you as well. Now, if you want to understand how this works, number one, book a session with your coach, or number two, go to the CFO program, the cash flow options program, and one of the modules there is the ultimate earnings strategy, and it walks through exactly what I'm about to do, right? So if you don't understand this for any reason, book a session with your coach, watch that webinar, right? It's not long, and it will help you understand exactly how to make money with stocks that are having their earnings. So what I want to do here is I want to buy a put option. Why am I buying a put option, Sean? Well, let's go and have a look at our stacked moving averages, right? So if we have a look here at Apple, it's clearly in a downtrend, right? We can see the 89 on top, the red line, then the purple line, 55, the 34, the 21, and the 8. When they're stacked in that sequence on top of each other like that, then that is a downtrend. With our earnings strategy, when you're in a downtrend, you buy a put option. Okay, so we're buying a put option. We're choosing the 125 strike price. Why are we choosing that? Because it's approximately a delta of 20. It's out of the money. One of the few times that we buy out of the money options. Why? Because volatility will typically double leading into the earnings report date. So we can afford to buy an out of the money option, which is 100% time value, because the volatility increasing will keep the premium up. You won't get the normal time decay that you usually get. Now, we're going to choose the 29th as our expiry. Why? Because earnings for Apple, like we just saw, is on the 28th of July. So what you do is you make sure you buy the option that expires in the same week that the earnings is coming out. So you've got two types of options. You've got the monthly expiration, which is the third Friday, and then you've got weekly options, which expire every Friday. So we're going to buy a weekly option that expires on the 29th of July, with earnings coming out on the 28th. It's in the same week. This is the option chain, the one that expires in the same week as earnings, that's being impacted by the volatility. So that's why we're choosing the 29th of July expiry, 125 put option. Okay, so it's going to cost $180 a contract. I wouldn't pay any more than $190. Okay, now let me know if you enjoy that, if you think that's a good value add for these weekly videos. If you'd like me to put in, look, this is the price. If you don't think you can get filled there, then increase your limit order till this point, but don't go beyond that. If you guys like that, let me know. How do you let me know? support@cashflowoptions.com.au. Don't pay any more than $1.90. Now, I would close the 125 put option, which is an earnings trade that we're doing here, if it is not profitable and riskless. I don't have time to talk about that now, but again, watch the webinar within the CFO program to understand what that means. Also, I would close the trade if it goes beyond the most recent active high. What does that mean, Sean? Well, let's go and have a look. So if we have a look at Apple, we know it's in a downtrend. We've got a high here, a lower high again, a lower high, and now another lower high, and obviously lower lows. Okay, that's what a downtrend is. So lower high in price we're talking about, right? So when you're in a downtrend, that's what you see. Now, this is the most recent active high. So what that means is if the stock now moves above that high, then that beautifully clear downtrend is no longer intact. Okay, so if it moves above 143 and 49 cents, I would close the trade out. Now, I could set an alert. I could click on alert here, go to set an alert, and click on price. And what I could do is I could type that in right there. I could type it in. I type in 143.49. Close Apple earnings trade. Now downtrend has been broken. Something like that, right? So that's what will populate on your interactive brokers as soon as you open your interactive brokers up. As well as that, it gets sent as an alert to your email. I get all my alerts sent to one specific email address that's only for alerts. And it makes a beeping noise on my phone when I get it. This is the way that I keep track of these things as well. So I click on OK. Okay, and that's it. Okay, so okay. Right, so that's a way you could set an alert. Let me know if you like that, right? The way that I did that as well. Give me some feedback. So that's what I would do there for the earnings trade on Apple. All right, my friends, I hope you enjoyed that. Let me know if you enjoyed that format this week. A couple of new exciting trades there to the downside. Keep an eye on the markets, okay? We could very easily move down. Now, remember, the markets are not open on Monday, Independence Day in the United States, and the market is not open. Now, if you wanted to know the days that the market is not open, obviously this Friday coming, 4th of July, Independence Day, these are the other days for the remainder of the year where the markets will be closed. Okay, so you might want to take a screenshot of that as well. Okay, so it's a short week this week. We start trading again on Tuesday. The trades I just showed you will be for Tuesday, obviously. That's when the market opens. And now you have all the parameters set for that trading day. All right, my friends, I hope you enjoyed it. I'll talk to you again next week. All the best, and bye for now.